let's get started. Let me remind you that assignment 1 is due November the 6th, and I can see that a lot of people have worked through a lot of assignment 1 already. I actually jumped ahead to all the duration stuff, which we'll do in the first half of the lecture. That's good. Assignment 2 is also due on November the 6th, and we're going to be talking about options today in the second half. And there might be a few questions in assignment 2A that we're not quite there yet to answer, which is fine. Just the main thing that I need for assignment 2A is your position, like what options you're going to buy and what stock you're going to buy. And don't worry about necessarily answering every single question in assignment 2A. We can always do that when assignment 2B is handed in. Okay? Because I know that assignment 1 is going to take a fair bit of time, and probably it's best to take away from assignment 2A time. Okay? Because 2B is not due until the 27th of November.
So all we want to do is put in our position?
Right, and whatever other questions you can answer, if you can't, you don't have time to find, we'll do them later. Okay. So assignment 2A, as I said, should not take much time. And I recommend that you don't take positions in like 25 different options and 25 different stocks, because you have to track that every day. And just every day it's a nightmare trying to figure out what happened to your portfolio. Take a small position. You've only got $1 million to invest. Okay, yeah.
I was just going to confirm that as part 2B, you do need evaluation for every day. So you need to update that.
Absolutely.
Daily.
Yeah, I want you to practice every day, just like, well, if you had $1 million, maybe I guess you'd like to go a couple of days without looking. Be afraid to look to see what happens. But yeah, I want every single day. Any questions? Yes.
Got a visitor.
Yeah. Oh yes. Thomas, you got it.
This is Christian. He'd like to introduce himself.
All right, my name is Christian Lewis. I'm actually from Chapel Hill. I started up. I'm a co-founder of a medical multimedia company. We are currently developing patient education software. Actually, right now we're doing CD-ROMs for patient education patients to learn about procedures and so forth. Sometimes set up in kiosk settings in doctor's offices.
I've got a guest also. This is Joe. Let him introduce himself too real quick.
Good morning. I'm Joe Fitzgerald. I'm from Gaithersburg, Maryland, and I work for my family's business. We own and operate 26 automotive dealerships, and I'm the assistant general leasing manager.
Any other visitors? Okay. What else do I have to remind you of? Whoops. Do not hesitate to contact the TAs. Now we have 3. Okay. The list is growing. The other thing, make sure, like, even if you're not contributing to the news group, which I hope that you will, like everybody should, post, in my opinion, at some point. Even if you understand everything in the course, like really clearly, you could be responding to some questions or whatever. So the minimum you should be doing is monitoring what's happening. I know some people like look at it and then just print all of the exchanges. And I'm obviously the most frequent contributor. And basically my rule is that if the question is unanswered for a day, then I'm going to come in and answer or try to answer, or I'll respond to somebody's responses. So try to get in there, take a look at what's happening. I think it's useful. Yes?
Could we get some clarification on how much we're allowed to work together on the assignment?
Yeah, did you read the news group?
Yeah.
That wasn't clear?
Well, not exactly. You did say you just didn't, it sounded like you said as long as we weren't trading spreadsheets or comparing
Yes.
answers. But how about if we have like a group of 4 or 5 people and we're working on it together?
Well, it's not a group
We're
assignment.
sort of solving it together then.
Yeah.
That's not okay.
Yeah, it's not a group assignment. Like, I want you to work individually, but I also want you to be able to talk, and it might be a group of 4 people, where you talk over, one of the concepts or get clarifications. I don't want.
We could talk about things only in general, but not in relation
In
to specific
general,
problems.
it might be a specific formula, how to set this up, but I don't want like a group of 4 or 5. If it's happened already, let's not worry about it, but I don't want a group working on each question, because it's supposed to be an individual assignment. Is that clear? It's impossible to exactly state what I want. You just have to use some judgment. In the past, I think I told you last time, in the past I have on very few occasions received like identical spreadsheets for the entire assignment, which really bad strategy. And they handed in like in the staff, like one after the other. You would think that it mixed up a bit. Yes.
I have a question about the banker's formula one that you posted.
Did I post the incorrect formula?
Well, see, I don't know. The impression, I never heard this formula before. The impression that I got when you said it in class was, well, if it's $100 at 10%, it should be $90. So
I said roughly.
So like,
distinctly
said roughly?
remember clarifying that.
okay, so, see, I thought it was exact. So my formula saying 100 divided by 1 plus the interest rate is absolutely wrong then. Because when you did it was like
No. So the interest rate is
10%.
10%.
And 100.
And the formula would be the par value of the bond
So it's like 100 divided by.
minus the interest rate
Okay.
times the par value of the bond.
Okay.
Okay, so that in case would be 100 minus 0.1 times 100. That's $10.
Okay.
Right? Now that is the rough formula. Okay? And it turns out that the difference between what I said and the exact formula is a strange convention of 360 days in a year. So if it was truly like a 1-year bond, then we have to make this day adjustment.
Which is what you did in that formula on that.
Yeah, so
Okay.
the real formula is 100 minus R, which is 0.1, times 365 divided by 360, which is real close to 1, right?
Right.
Times the par value of the bill.
Okay.
That's the formula I posed.
Okay.
Okay? Yes.
Schedule review session.
Review, yes, right at the bottom here. Review section, first one is Sunday, 7 p.m. And Doug and Patty, I know, will be there. As for the room, I haven't established the room yet, but I will post it right here. So this is a good place to post stuff. This is the index page for 350. So you should maybe put a bookmark in your Netscape for that. Okay. Any other issues? The option stuff is at the back of the class if you haven't picked it up yet, or you could do it at the break. Let's go and return to forward interest rates. We talked about forward interest rates last time. And I introduced you to this formula. And there's interesting exchange on the bulletin board about an alternative interpretation of this 1F2 is kind of a forecast of the future spot rate. So I encourage you to take a look at that. And we kind of did a very general formula that you could use to get any forward rate you want. Certainly this is directly, or at least this one down here, can be plugged directly into the problems in assignment number 1. So this is the semi-annual version of a forward rate, and this formula could be used to solve the questions in assignment number 1. one. What I wanted you to think about was this alternative interpretation. So people, I said that this forward rate, like the forward rate between 1 and 2, is the rate that you need to get on an investment, on a rollover kind of strategy. So you go 1-year CD, rollover into another 1-year CD. The forward rate is the rate that equalizes the returns on investing for 2 years, locking in a 2-year CD, versus the 1 year and the rollover. That's all it is. It's basically you could consider it a plug number if you wanted. It's like the ratio of 2 interest rates, the longer term and the shorter term. So you can see that I8, the 4-year rate is known. 0I6, the 3-year rate is known. So it's just basically a ratio of 2 interest rates. Yes?
Is that theory or are those actively traded? Like forward rates, a 1-year CD that I can buy for years?
Well, let's talk through that. So that's this alternative interpretation. Okay, so right now, it sounds like a plug number. It sounds like, okay, well, in theory, this is what I need to get on the rollover to equalize the strategy, and maybe that has something to do with my forecast of what's going to happen 1 year from now, or in this case, 3 years from now. But can we transform that interpretation into something that's more practical? Okay, and this is where this alternative comes in, and this is actually a tradable sort of strategy. So this is a situation where suppose that we've got some cash coming in next year, not today, next year, equal to $100 million. And I said last time this might be like a pension that knows with high probability that there's going to be a cash injection of $100 million. Who knows what it is? It could be contributions, it could be some note coming due, whatever. $100 million next year, but not today. Now, the idea in this example is to do something today. Our investment horizon is 1 year from when we get the money, which is like 2 years from today. Okay, so what are we going to do? And we're faced with the following situation. We've got a 1-year zero with a face value of 100 that's trading at 92.59. Okay, so that's 8% yield. And a 2-year zero that's trading at 79.74. And this is a 12% yield. And you should be able to get these prices. Notice this is annual rate, no compounding, to make it simple. Often I will do that, like on an exam question or something like that. I'll just assume annual rather than semi-annual interest rates to make it simpler. So we've got something for 92, we've got something for 79. And we want to do something today. That's basically going to lock us into an investment over these 2 years. So this is what we're going to do. We're going to sell short the 1-year bond. Okay. And as I said last lecture, sometimes this is a difficult concept to explain. And actually, I'll try to explain it, but if you've got ideas as to a better way to pitch this story, I'd be very interested in seeing that posted or emailed to me. Okay? So what is a short sale? It's basically when you sell something that you don't have. So often, for example, with stock, we'll start out with a stock example. And this is a stylized example. It's not exactly how it works, but roughly speaking, the concept's the same. Suppose that you want to buy 100 shares of IBM. And you could go phone up your broker, and they could go and do the transaction. And you pay the broker, and you get the 100 shares. Then maybe you hold it for a year and sell it. So it's cash out for you today, and then in a year, hopefully it's cash in. Okay, if they're not gone under. Okay, yes?
When you sell short, you hope the prices will go down. You're thinking prices, you expect the prices will go down.
That's exactly right. So anytime you sell, you hope the prices go down. But this situation, you are buying, okay? You phone the broker and ask for the 100 shares as cash out today. Okay? That's my example to start with. So the alternative is that that you phone me. Okay, and what is IBM trading at right now? 98 to say 100. So the alternative is that you phone me, and what I do is I sell you the 100 shares. Okay, so what you're going to do is you're going to pay me $10,000, which is the market price, and I'm just going to write out a piece of paper that says, anytime you want to sell, fine. The only difference is that you don't actually have the certificate. So if you actually held the stock, like in my first example, after a year, maybe the price goes to $90. There's a loss. You sell it for $9,000. You get $9,000. With the second example, you get a piece of paper from me, and you phone me up after a year and say, well, you know, I want to sell this now. And price is $90. I have to pay you $9,000. So for you, it's identical cash flows. But for me, I got $10,000 coming in, and at the end of the year, I've got $9,000 going in. So notice that I've benefited from the price going down. Okay? So this, I call it a stylized example of short selling. It's an example where I never transacted in IBM. And actually there's an advantage to this because anytime you go and transact in the stock market, it's costly to do. There's transactions cost, brokerage fees, and stuff like that. There could be some advantage to doing a side deal where you actually don't get the certificate. Like, how valuable is it to have that certificate? Now, an issue is my creditworthiness, but we can take care of it by putting good faith money down and stuff like that. So that's a very stylized example, and the bond idea is basically the same thing. That we're going to sell the $100 million face value 1 year zero. Okay, we don't have it, but we're going to sell it. So let's say it's me again. I'm going to sell it to one of you, and the price is $92.59. You're going to pay me $92 million for this bond, which you actually never get. You just get a piece of paper. And at the end of the year, we know what it's worth, $100 million. I'm going to pay you $100. So the difference between, well, actually, this is, like, in a way, it's like me issuing the bond. It's basically the same thing the government does, isn't it? The government sells the bond because they breed off the money, right? We're in a huge deficit, $6 trillion overall debt. Same basic story. Okay, so I'm actually selling this bond that I don't have, and you're paying me the money. The other way to look at this is that I'm just taking out a loan. So you give me the money today, $92 million. The interest rate is 8%. At the end of the year, I pay what you gave me plus interest. So another way to think of this bond example, this short sale example for a bond, I think is the easiest one. It's just like I'm taking a loan, and you're giving me the money. It turns out that an immediate question is, you know, why would you do this for 8%? Like, surely this is riskier, you know, to go to me rather than to go to the government. And a lot of this has to do with what I do with the bond and my cash flow situation. So I can reveal to you that with probability 1, I'm getting $100 million next year, cash in, and it's yours. I could sign it over. So there's very little risk. And I could also say, and show you all the documents, that I'm not just going to take this $92.59 million and squander it. I'm going to take it and invest it in the safest possible thing, a 2-year loan. So the risk of this loan is very, very small. Very small. Okay, now there's a question.
What do you make out of the whole thing? You're selling it to, I can see where I'm getting that $100 million back.
You're making 8%.
I'm making 8%. What happens?
What about me?
Yeah.
Yeah, well, it's costing me 8%. Right? So I've got a loan for 1 year at 8% interest rate. Now, I better do something with that loan to make more than 8%. Right? Or it's just a total wash. Right? That's what I'm about to do. So I got to do something. You pay me $92.59 million. What I'm going to do with that money is I'm going to take it and I'm going to buy as much of the 2-year zero as possible. Okay? And I know the price of that is $79.74. And I'm going to buy as much as possible. And the cash flows go like this. At the end of the year, I get this $100 million coming in from who knows where, pension, whatever. I pay off my loan to you. Wiped off. It's gone. But I still hold the 2-year zero, which all of a sudden has got 1 more year to go. And then I can figure out how much it's worth at maturity. It's pretty simple, 100. And I can calculate a rate of return on the strategy. Does everybody see the cash flows? That 92.59 million comes in today. I used all of that money to buy the 2-year zero. At the end of the first year, I've got to pay up my loan to you. I used the $100 million that's coming in to do that. I've still got in my portfolio this 2-year bond that has only got 1 more year to go, so effectively it's like a 1-year bond. That goes to maturity, and I know at the end what it's worth. And I just need to calculate the cash flows and the rate of returns. Yes?
I'm still confused how this selling short relates to the forward rate. Are you saying, because you have it,
Wait.
okay.
We're real close.
Okay.
There's no relation yet. There's
Okay.
no relation
Good,
whatsoever.
I didn't see one.
It's just a
now.
story so far. I'm building up to
Okay.
relating it to the forward rate. We're real close. Yes?
Why would I loan to you at 8% if I can get 12%?
That's a different investment. Okay, so it might be that your horizon is only 1 year, shorter term. Yeah, but it's a reasonable question. If you don't loan to me, I'll find somebody who will for 1 year. Maybe you have a preference over 2 years. That's fine. Okay. And if nobody's available, then interest rates will change. Okay, well let's actually go through the mechanics, and this is what happens. We get 92.59 million. We invest in as much of the 2-year bond as possible at 79. And right here is the formula for the number of bonds that we can buy, the number of 2-year bonds at this price. And in terms of $100 units, this is 1.161 million bonds. Okay? So all I've done is kind of divided what I'm getting by what I'm paying to figure out the number of bonds that I can buy if I exhaust all the proceeds. Okay? Now let's calculate a rate of return on this strategy. So the rate of return begins when I actually put some money out. The first year is like no real money going out. Like there's money going out, there's money coming in, and it kind of cancels out. But I'm actually investing real money with this $100 million cash flow. At the very beginning, I'm nothing. I managed to generate something by the short sale, but I spent it all. It's a zero net investment. But I'm using $100 million of my money at the end of the first year. And if I get 1.161 million, basically, of these bonds, at the end of the second year, what is this worth? $1.161 million. Because I know at maturity, the 2-year zero is worth $100. Right? So it's basically 100 times this amount. Everybody see that? That this is what we paid for it initially, 79.71. At the end of 2 years, the bond is worth 100. So we get 1.161 $1 million. Yes.
And that should be the same as investing 92 or whatever it was million at 12% in 2 years.
Well, we can figure out what the rate of return is. Actually, we could do this almost in our head. That if you invest $100 million at the end of year 1, and at the end of year 2, you get $116 million. What's the rate of return? 100 million goes to 116 million.
16.
Yes, 16. And that's exactly what I've done here. Is I calculated the rate, 16.148%.
Right, but that's based on your initial, on 1 year.
That's a 1-year investment. Cash went out at the end of the first year, and there's a payoff at the end of the second. Okay, so what I've done is today, I've locked in a return for next year. So I've tied my hands, and I've actually done a transaction today that guarantees, there's no uncertainty here, it guarantees a 16.148% return in the second year. So today, I have no money to invest today. I do a transaction today to lock in a return for the second year where I actually do have some investment to make. And that investment returns 16.148%. Yes?
Don't you have $100 million to invest today?
No, I don't. I don't have anything. I'm zero.
Then how'd you cover the short position after 1 year?
No, it's, the $100 million comes at the end of the first year.
Well, how'd you cover that?
The cash flow is just coming in, right? I said that maybe it's a pension flow coming in, or maybe you've got some money somewhere that you know is going to come in. Maybe you win, you know you're going to win the lottery, right? Probability one you're going to win in 1 year. I don't know where it's coming from. All I know is that you've got a cash flow next year, not today, or next year, and let's do something about it today.
There's clearly an opportunity cost when you're using the 1 million, investing it between
100
year 1
million.
and year 2.
Yes. But this is a pretty good rate of return. Look, sure, if we waited, if we did nothing, right, suppose we did absolutely nothing today, and then 1 year from now I get $100 million, and then, yeah, I've got to invest it for a year, but I have no idea what the interest rate is going to be, right? But when I look at this, 16.148% is a pretty good rate. Well, I think so. So maybe you're willing to lock that in. You know, maybe I'm willing to lock it in. Maybe you want to let it ride. That's fine. We have just different views of what's going to happen. Yes?
Isn't that deceptive though? Because in the first year, you're actually paying out interest to get a higher return in the second, so you're really losing the first year.
What do I lose? What are the cash flows that I lose?
The interest statement, because you borrow 92 million and you're paying back 100 at the end of the year.
Yes, but what am I doing?
Well,
Like in effect with that money, I'm investing it at 12%. So my cost of, another way of thinking, my cost of funds is 8%, but I'm investing at 12. So the net is positive. just so happens there's no interest payment on this. Yes?
So you would only do this, like if you thought the 1 year, in the first year, the 1 year was expensive relative to the 2 year, and that you thought that rates were going to decrease from the first to the second year, and be actually, so your rate of return would be less than 16%?
I would only do this, let me kind of rephrase what you said, and put it in the context of what Don was saying. That I would only do this if I believe that the 1 year rate, 1 year from now, is going to be less than 16%. Does that make sense? So if I let it ride, and I really believe that I can get 14%, well, it doesn't make sense to let it ride because I can lock in 16 today. Is that
Yeah.
square?
Yeah, so how would you calculate it? Like in year one, you have the price of the 1 year, the price of the 2 year. And your theory is essentially that the 1 year is expensive relative to the 2 year. Is this the only way to kind of go about calculating, like?
Basically, I calculate the return on the strategy, which represents a long and a short position today.
Right.
Now, the cool thing about this, well, at least in my opinion, is that this 16.148% is actually the forward rate. The forward rate between 1 and 2. So work it out. Okay, you can do it on your calculator. What is the formula? In this case, it's 1 plus 0R2 squared. And what's 0R2? 12. Equals 1 plus 0R1 to the power of 1. What's 0R1? 8. Then we solve for 1 plus 1F1 to the power of 1. You do that? 16.148%. Yes?
Looking at the total money you get back after 2 years, you've invested, in the sense you're getting back $116 for every $100.
That's correct.
But you're also paying out $8, approximately $8 when you return $100 for the $92. You get it?
Well, it's like, I would agree with that kind of intuition if there was like a coupon on this bond. But actually, there's no money really out of your pocket in the first year, over that first year. Like standing today at time 0, there's no money out.
But at the end of the first year, at that time you're losing it.
You're investing. Think of it as investing. You're paying back the short, I agree, but that's kind of part of your investment. Yes?
I see that you're getting 116 back, but isn't that really a 2-year investment, not a?
No, it's a 1-year investment because I didn't have any money to invest in the first year.
But really isn't part of that 16% because you were making money the first year, because you were reinvesting at 12 and it was only costing you 8. So isn't that really?
I totally agree. So it's a result of a trade that I entered into today.
But why would you say that all that money's being pushed to the second year, when really you're making a lot of it the
No,
first
there's
year?
actually money being transacted, but my actual hard investment, the cash that actually goes out on a net basis, happens at the end of the first year. Okay, so we could be 2 investors, okay? And you've got $100 million coming in at the end of the first year. And you're going to wait for it to come in and invest it at whatever rate for 1 year. And I'm identical. I've got $100 million coming in at the end of the first year. The only difference is that I'm going to lock in the return today by using this transaction. So both of us have 0 in the first year. And you know, one of the basic things in calculating a return is you've got to divide by your initial investment, right? My initial investment and your initial investment are identical, $100 million. Okay. We can calculate a return based on an initial investment of 0.
Well, you're sort of committing yourself at the end of the first year,
Absolutely.
even though you don't
I'm
have to.
committing to 16.148%. And maybe in 1 year, the interest rates are 21, and you're going to do better than me. Maybe they're going to be less than 16, and I'm going to do better than you. But the cash going out is at the end of the first year. Yes.
What'd you do with the 92 million the whole year? Because
The 92 million, I just took it and basically immediately invested it in the 2-year zero coupon bond. So I used all of that money.
But you just told Ken you weren't getting to the end of the first year.
Mhm.
You just said the prior comment, you weren't getting any money to the end of the first year.
Yeah, I'm just taking the money and I'm locking in a transaction, but it's
January
not my
1.
money, basically.
January 1, you're locking in a transaction for
Right.
92 million into the 2-year bond.
So it's January 1, okay, I sell the 1-year bond, I get 92, and then immediately, like I never have the chance to even look at the money, right? I don't get a suitcase or anything like that. Just immediately, it's translated into this 2-year bond. Okay, and the only thing I get are these certificates saying that I've got 1.161 million of the 2-year bond, and I've also got this other certificate that says I owe $100 million. Okay? And that's all that happens. So my net investment, the actual investment, in terms of my own personal money in the January 1 is 0. I'm basically, if you've given me the 92
If you
million,
look at it that way, I mean, I look at it like, you're on the hook for 92.5 million.
I owe 100 million, basically. If I take the loan for 92, I owe 100. And it just so happens I'm going to pay it back with the inflow I've got at the end of the first year. Yes?
It still doesn't make sense to me though, because if you take a 92 at day 1 of year 1 and invest it in the 2-year, I don't see how you can say the 16% is just a 1-year rate if you're actually investing it. If you're investing at day 1 of year 1 and then you're getting the money 2 years later, it just seems like a 2-year. The 16% covers
Yeah.
2
And
years.
in a way, I kind of agree with you that the trick here is that we're getting to use funds at 8% to invest in something with way more than an 8% return.
Right.
Okay? But, you know, to actually calculate a return, you need to have some initial investment. And January 1st, we have no money of our own actually going out. It's a complete wash. You're buying something and selling something. You're borrowing for the speculative type of loan to invest in the 2-year bond. So the return is actually only calculated after you make the dollar commitment. And that's at the end of the first year.
Even though you're repaying that loan with an entirely different source of cash. You're getting 100.
Exactly. So I guess there's, is there another source of cash that I could repay that loan with?
You could take out a loan.
Hmm?
You could take out a loan.
You sell
I
short
can
again?
take out another loan, but is there another source? Yes.
You can sell your 2-year zeros.
Yes. I can sell the 2-year zeros, and that is a risky strategy because I don't know how much they're going to be worth. Right?
Are you saying sell the 2-year zeros after year 1?
That's right. I could do that. But I'm not. That's not my example. My example is I'm going to hold those for 2 years.
So the whole reason this is just a 1-year rate is because it's not our money until the end.
That's right. We have to have a net investment to calculate a return. We actually have to commit something to calculate a. I need some base capital to calculate a return.
What if your $100 million didn't come through? Then you're really in the hole.
Then my example kind of blows up. Right? Now, are you really in the hole? What is the risk?
The risk is that your 2-year zero isn't worth enough to cover it at the end of the
That's
first
right.
year.
But it's probably going to be close anyways, right?
So for all of us accountants, then you're committing and you might lose money and you don't know.
That's right. So it's way riskier if you're just going to play that game. But this game is pretty riskless, given that we know, and I constructed the example so that you know that you've got some money coming in. Yes?
I just checked the math on that, and you end up $3 million ahead, I think. If your loan doesn't come through, if your cash flow doesn't come through at the end of the first year, you've got to bail out on the 2-year bond.
Okay, now,
That depends
Depends on what the market rate is, I assume,
Price
for sure.
Yeah, what's the rate? That's the key.
Okay.
So what rate did you use for $3 million?
I say it stay constant at 12.
At 12, yeah. So if it's 16.148%, what is the situation then? Don't need your calculator for it. Break even. Break even. Thank you. Is that correct?
Yeah.
Okay. Yes.
I think one thing I think everybody's getting hung up is on the 16%. Your real return was 12% over those 2 years, compounded annually. And that's what everybody's, they remember.
If I invested
Right, if you
my
invest.
cash, $100 million, in January 1st,
Right.
then the rate of return that I'm getting is 12% a year. But it turns out that I made no net investment. I just made a commitment
Right.
to an investment that really takes place at the end of year one.
Right, you didn't have the money now, so what you're trying to do is just lock in at a better rate. And if you did have the money at beginning of year one, you'd have had to invest at 16% in year two to make that 12% return over that 2-year period. That's
right.
it.
Okay, so you can phrase it like that. Right, so really it's like the rough sort of intuition is that you're making 12% in year one, 12% in year two, whereas the cost of funds is 8% in year one.
Right.
And then, and this is really rough, 12 minus 8 is 4, plus 12 is 16.
Right. And the reason I think in solid perception why you do this is just because you think that rates are not going to be higher than 16% in the second year, so that's why you're doing it this way.
That's right.
I mean, you don't have to do it
be
this
higher
way.
than 16, then this is a bad trade.
Right.
Yes.
Sorry to keep going.
No, this is good because it's a really important concept to understand.
In a way, though, at the beginning of year one, I would look at it more that you're borrowing money now from one source to invest it in another source.
Yes.
So I look at it as more than just a commitment, and that income is earned because you borrowed from one source and invested in another source, and you made money on the spread. So I would argue that 16 really does, a lot of it belong in year one because you're borrowing money from one source, investing in another source, and you're making money on the spread.
I kind of half agree with what you're saying, that you're making money on the spread, but the actual, if you're doing the accounting on this, that it would be in the second year that you calculate the rate of return. Yes.
Okay, good. At the beginning of year one and at the end of year one, you're getting 100 million. So it's a wash. It's not. Obviously, I can't explain it. Your money's not going in until the second year. Whatever happens before that, it's at the 12%. Yeah, somebody's giving you 92, and at the rate you're investing, you're not losing anything. Your money goes in the second year.
Well, the only problem with that intuition is that you potentially could lose something if you didn't have the $100 million for sure coming in at the end of the first year. That is, the rates went above 16. Yes.
I'm not sure how the accounting works on it to actually, in the future, look back on it, but I think there's two ways, if I understand it correctly, that it sort of makes sense to me. One is just simple alternatives, that I either have a choice to do nothing today,
Yes.
and a year from now invest it, say, for an example, 8%, and earn 8% for 1 year. Or I can do this today and get 16
That's correct.
for 1 year. Another alternative would be to say, if you did want to look at it as a 2-year investment, well, the investment is calculate a 0 return for this year, a 16% return for 1 year, or the alternative is a 0% return for this year, an 8% return for 1 year.
Okay, do people like that intuition?
Yeah.
That's better.
It's from
I like
our
that.
account on that.
No, don't like it. Here's one is the wash, so he's saying 0. Yeah. So there's a 0 and a 16. Or a 0 and whatever if you want to let it run.
What do you mean by the 0 and the 8? Meaning the first option would be, if I do nothing for this year, I'm earning no money. Okay, and then next year, I'm going to invest my $100 million and earn whatever the return might be. In this case, it was 8% for 1 year.
Yes.
And if I
If
do
interest
go through
rates
this
don't change
transaction.
over the year.
Yeah, they don't
So
change.
the 1-year rate today is 8%, suppose it doesn't change, it's 8% next year.
So you could look at it in hindsight and look at it as a 2-year investment in some way.
Yeah.
Okay, I'm still not clear. What you just said, that first year, if we, say we do something, are you saying that first year, using someone else's money, not our own, you're getting that 8%?
No.
No, it's just saying if you wanted to look back on it after that 2-year horizon, in hindsight, it's like saying I have, I'm earning no income right now because I'm in school. A couple years from now, hopefully I'll have a job. If I wanted to, I could look back and say, well, I kind of averaged, if I'm making $40,000 when I graduated and nothing now, I could say, well, over 2 years I averaged $20,000. It's not a realistic way to look at it, but it's another way. If you want to say if you force yourself to say over a 2-year period. So we have a 16% return for 1 year. And if we force ourselves to see it over 2 years, then you have to compare it to the option, which is the option is 0 for this year and an 8% return or whatever.
Whatever. Okay, no, I kind of like that.
One thing I find it's good until you get to the second year, you're expecting a 1-year CD or 1-year investment is 8%, as if we're getting something out of the market. Right now, the market is fully expecting a 1-year CD next year to be 16.
But that's not necessarily true.
Well, at this current time, it's expecting in the future that interest rates are going to rise. There's no reason.
Okay, that could be true.
Other than.
But we don't know it's exactly 16. Actually, there's an exchange on the bulletin board on this that is not exactly the forecast of the market. It could be some other stuff in there, like risk premium and stuff like that. But the 2-year rate could be higher than the 1-year rate just because you kind of lock your money for 2 years on the flexibility. So it's not completely just a pure forecast. But I agree with you that the market expects rates to go up from 8, right? But this is pretty extreme. The 1-year rate goes from 8 to 16, doubling. I'm not sure that's the market expectation. So this is like, to pursue like the MBA student intuition. You don't have any money right now, let's say, but with high probability that you're going to get this like $1 million signing bonus when you graduate. Right? You look at the interest rates today, and you see like an 8% for 1 year and a 12% for a 2-year investment, and say, well, I can't get the 12% because I don't have the money today. But what I could do is borrow today, use all the proceeds to buy the 2-year. Okay? When I get my signing bonus, I just pay off my loan, and effectively I've locked myself a 16% return. Now you want to calculate that over 2 years. To me, it just seems that the money you're using is the $1 million signing bonus. That's your actual cash out. Your investment technically is locked in today. Yes.
I'd be interested to find out if anyone could, or I would have no way of knowing how to do it, but do the research on how they account for that. How the accountants.
What you would do is you would account for interest expense at the end of year 1 equal to 8%, and at the end of, depending on what your intention was with the security, you have to hold to maturity, you can carry it at cost. You might have to value that 2-year bond at the end of for year 1. If it's a cost, you would have no gain or loss. If you were holding it in your trading portfolio or your sales portfolio, you'd have to take the current market value at the end of year 1 of that 2-year security, and you'd have a capital gain or loss depending on the difference in price.
So it depends how if you account for it as a buy and hold or a
right.
trading.
And if it's a maturity,
this would be a buy and hold.
Right, it would be a buy and hold because you're going to hold it to maturity. So it wouldn't have any income impact. The 2-year security wouldn't have any income impact at the end of year 1. You just wait to see what it'd play out at. And you'd end up recording a 12% return over those 2-year periods.
The other even more direct thing is that you can basically just lock the 16.418 by phoning your friendly investment banker and let them take care of it. Let them do the trade, so it charges you a bit of a premium. But you know, the whole point of this example is that the forward rate is not this construct, this plug number, this ratio of two rates. It's like an investment rate for a particular strategy that's available. I'm not going to say to everyone, because usually you have to do kind of large numbers in terms of these transactions. But it's available to corporations, it's available to large investors. You can actually do something like this. Yes?
How do you evaluate this? Let's say you wanted to do something 30 years from now, like leverage your 401k payment and buy 30-year bonds.
Yeah, not gonna
Knowing that the rates are so low and the variability of rates, how do you really evaluate whether it's a good idea or not?
Well, you know, a lot of what you're asking is like a forecasting question and an asset allocation question. Like, what should you be doing personally with your money right now in terms of planning for?
Well, no, my question is, let's say, I think
the underlying question is basically that. And if the interest rates were low, like they were at 2.9%, I'd be borrowing like crazy short and investing long. And actually, if I just freedom to use the borrowings, I'd be probably very exposed to the stock market. So for you, your asset allocation decision, probably you're doing this already. You're borrowing like crazy to get the kind of expected lifestyle that you will have after you graduate and pick up, you know, your $90,000 salary or whatever. Hopefully.
Well, the question really is let's say I think my 401k is going to be $1 million in 30 years from now. So I take that million, discount it, and buy 30 years to match up with that. That's really it.
That's going to be hard to pull off. That's what I'm saying. This one is fairly easy to pull off, but against 401k, that'd be more difficult. And anyways, you want to be invested in equities for 30 years. Don't invest. You know, you can have a portion in bonds, but equities, I showed you the numbers. They're just dramatically different. Okay, so we really, you know, remember I told you, I warned you about this, okay? That the last lecture said that this was one of the more difficult things to pitch in this course. But I think the discussion was valuable, even if, you know, if it's a bit confusing, you know, think about it, do some different numbers, you know, really think about this, whether it's reasonable, come up with a different explanation, and we can trade ideas on it. Yeah.
If we're doing this for our assignment, can we? And do we just have to make sure we have the amount in our portfolio to pay off the short? I don't get it.
Are you doing this in the assignment? I forget.
Well, when we take, I mean, can we short stocks for assignment?
Our $1 million portfolio.
Oh, the $1 million portfolio. Oh, okay. So with equities, this is the way it works. When you short, you actually don't get the proceeds.
Right.
So what you have to do is to actually put 50% down as good faith.
And we can do it that way?
Yes. But there's a limit to how much you can do. So for the assignment, I don't want people, you know, going out and borrowing like $100 million to invest, you know, with a huge 100-to-1 leverage. You've got $1 million and...
So we can essentially up that to 1.5 million, right?
Well, there's... Yeah, I think I put a limit on the maximum number of short sales. I forget what it was. So I don't even think you can use that. But you can up it, I agree. Effectively. Okay, well, that's forward rates. I know there's questions on it, but think of it as not just the rollover rate, but a real investment rate that you can lock in. And I suggest, and this is extremely good advice, okay, that you should like underline. I suggest that you just like open the paper and pick out a couple of zero coupon bond prices, not the 1 year and the 2 year, but some other bonds, and go through the cash flows exactly like I did. So maybe you're expecting cash flows at the end of year 2 for 1 year, or for 2 years. Go through all of the cash flows, make sure that you can actually do this question, or generally. And I think I said that sometimes the best way to study for my exams is to take some of the examples and then just change them. My midterm has got just remarkable serial correlation, autocorrelation. questions are basically the same, but with different numbers. It reduces the stress we're doing believe on the midterm for people that believe in it. You know, are really stressed out, and then say after the midterm, oh gee, we're actually telling the truth. So, and I think that there's a question like this. Okay, so you need to go through and do an example, construct, you know, it doesn't even matter if you open a paper, just use 2 different interest rates and 2 different maturities. Go through the cash flows, do a timeline, where the cash actually comes in and where it goes out at every year, so you really understand what's going on. Okay? Yes?
Is there a reason why you have 2 different prices for the 2-year bond? For example, there at the top it's like it's only off of 3 cents. At the top it's like 79.74, and we buy it at 79.72.
Oh, the reason is that must be a typo. And I guess I need to figure out which one is correct. It looks like this long one. The second one's probably, it says 79.72. It should be. Just let me, I'll write that one down.
How much that cost you?
Okay. Term structure of interest rates. Let's move on. Basically, this is more of an optional part for your information. There's a big link here to my thesis. That's why it's optional. But look through it. It's kind of interesting. And the term structure is just the difference between long-term interest rates and short-term interest rates. And I wonder if this will work. Term structure surfaces. Not found, no. Basically, the idea here is that just the difference between the longer-term rates and the shorter-term rates provide information about the state of the economy. Just remarkably precise information. So in the last 25 years, every single time that the shorter-term interest rate was higher than the longer-term interest rate, 3 to 5 quarters later, a recession began. Okay, so it's an indicator that has no false signals over the last 25 years. It gives advance warning for a recession, the timing, the duration, everything. And the key insight is that the interest rates are kind of forward-looking. They contain expectations of inflation, of economic growth, of a lot of things. So the term structure is quite a useful indicator for the macro economy. And that's what this lecture note is actually about. And you'll notice that I actually do even different countries with this same style of analysis. So this term structure is an indicator of future real economic growth. Works in many different countries. And there's graphs that you can link to. One of the, like in my dissertation paper, I showed that this single indicator was better than macroeconomic forecasts that were available commercially, which might be based on thousands of equations. And this is just basically you take the difference between longer-term interest rates and shorter-term interest rates, and it tells you something about what people expect for next year. Yes?
What does your model say right now about the rates?
Oh, it's flattening. Yeah. It means fairly slow, with slower growth for next year, but no recession. And actually last year when rates were almost totally flat, it was still saying slower growth, which it turned out to be, though some people were saying we're going into a recession. So it did not deliver a false signal. The last business cycle, it delivered exactly as it should, where it inverted in the summer of '89, I guess. So inverted just means that the short-term rates are higher than longer-term rates. Okay, so explore that. There's some interesting country examples. Germany, I think, was my my best example, where after unification of Germany, all of the macroeconomic models kind of had to be drastically revised. It's like this is a real shock to a country when this happens. And it turned out that my model didn't rely upon this 1,000 equation sort of setup. that it was really simple, was looking at financial indicators. And it did just incredibly well in forecasting what happened in Germany. And I published a paper there on that. And it did actually very well based upon past performance also. Yes.
Do you theorize that it takes some time to solidify in emerging markets?
In emerging markets, this has even got some power. There's a paper that, I don't know a lot of emerging markets, but there's a paper I've seen that it's actually quite flattering. It's called Implementing the Harvey Model in Chile. And just these people were dumbfounded at how well it did. Then I also got recently something from a securities house that's based in Hong Kong, and they implemented the model for 10 markets in the Far East. And they were very surprised at how well it did. But this is something that I don't do, like I did for the G7 countries, and let other people work on it after that. So, but it's, I think it's easy reading, and I think you might find it interesting. So, that's basically all I want to say about my thesis. Let's talk about duration. And I think everybody's kind of peeked ahead on this. What we want to do is to determine the sensitivity of a bond price to a move in the interest rate. That's the goal. The maturity, the face value, the coupon, it's just not enough information to tell us what the sensitivity is going to be. So this is an example where cash flows are $12 a year, annual compounding, and I calculate bond prices for a 12% interest rate, 13 and 14. So notice the bond price drops as the interest rate goes up. And notice that the bond price is 100 if the interest rate is exactly 12, the fair interest rate. So the fair interest rate equals the coupon rate, the price is 100. So we've already done the example of like a holding period return if rates went from 12 to 13. And this can be replicated for 12 to 14. But what I actually want to do is to develop a general formula that tells us, and this is important, let me underline the word approximately. Tells us approximately what's going to happen to the bond price if interest rates move by 1%. So benchmark is going to be 1%. What's going to happen to the bond price? This is the general bond price formula that we've already seen before. And what we're going to do is exactly what we did before. We've already looked at this derivative. We're going to take the change in the bond price to the change in the interest rate. And I actually want to quantify that. And I want to actually transform it a little bit. Suppose that I take the change in the bond price and divide it by the bond price. Suppose I do that. And what's that? Percentage change in the bond price. And then if I take the change in the interest rate and divide by, and this one's going to be less well motivated, divide by 1 plus the interest rate. Okay, it's less well motivated because I'm not even going to motivate it. Suppose you just did that. Okay? And I don't even know what that means. But it turns out that what it actually delivers is a concept that was initially proposed in 1938 by a guy called Macaulay. And it's called the duration of a bond. And what he was interested in was an alternative measure of timing of the cash flows of a bond. The zero coupon bond, you have to wait to the end to get your cash flows. A coupon paying bond, you get cash very close to the day, almost immediately. So even though these two bonds might have the same 10-year maturity, the effect of maturity of the cash flows is less for the coupon paying bond. Okay, so that was his intuition. So he wanted to move beyond this idea of just looking at maturity, that he wanted to link the cash flows and the timing of the cash flows to develop a different measure of timing, and he called that duration. And this is actually the formula for his duration measure. Okay? Now, it turns out a fairly easy formula, forget the derivative, to actually implement in a spreadsheet. And this is the formula for the duration. You take the present value of the cash flow in year 1 and divide it by the total present value of all the cash flows, which is just the bond price today, and multiply it by 1. And 1 indicates the period. And let's say this is like an annual period. And then there's a cash flow in year 2, so it might be a coupon of $12. You take the present value of that, divided by the bond price today, multiply by 2. 2 years. And keep on doing that, and if this was the 5-year bond, there'd be a present value of the cash flow in year 5, and that cash flow would be $12 coupon plus the $100 principal. Take the present value of that, divide by the bond price, multiply by T, which is 5. Add all this up, and you get a measure of duration. It's the so-called Macaulay duration number. So very much is related to the percentage change in the bond price divided by that thing that I didn't want to justify. It's kind of like the change in the interest rate. The change in the interest rate divided by 1 plus I. Okay? Just looking at this equation, what is the duration of a 5-year zero coupon bond? 5. And the reason? Present value of the cash flow in year 1 is 0. Year 2 is 0. All the way out to the very end. And what's the present value of the cash flow in year, let's say year 10?
Price of the bond.
Price of the bond. And what's the present value of all the cash flows?
Price of the bond.
Price of the bond. So it's 1 times T, is a 10-year 0? It's 10. So the duration of a zero coupon bond is its time to maturity. If we have semi-annual interest rates, then we would do this, and basically there'd be 20 periods for the 10-year bond. And at the very end, we've got the price divided by the price multiplied by 20. And that says that the duration in half years is 20. In years, it's 10. So you get the same answer, semi-annual compounding or annual compounding. So the duration of a zero coupon bond is its maturity. And that's kind of the benchmark that Macaulay used. Now, is the duration of, let's say, a 10% coupon bond that's 10 years greater than 10 or less than 10? Less. And the idea is that the zero coupon bond, it really takes you 10 years to get your cash. You don't get your hands on anything earlier than 10 years. Whereas the coupon-bearing bond, you get something earlier. So you can think of the duration measure as kind of a weighted average maturity of the bond when you're kind of waiting by when you get the cash. The maximum duration is always the zero coupon bond. Okay? This is an example of maturity against duration. This is what it looks like. The zero coupon is kind of a 45-degree line. So the duration exactly equals the maturity. And then as soon as I start putting coupons on, the duration declines. So, there's this formula, there's a spreadsheet formula that basically I showed you to calculate the duration. If I tell you it's a zero coupon bond, you need not do that. Or if you do it, you'll notice there's a lot of zero cells. Okay? But as soon as we get a coupon-bearing bond, then we have to do this exercise, take the present value of the cash flow, divide by the price, multiply by that particular period. Yes?
As a rule of thumb, even if it's a zero coupon bond and it's a semi-annual compounding rate, when you ask for the duration, are you asking for us to state it in the semi-annual terms or annual terms? mean, I know you can get either one, but if you just say duration, what are you expecting?
I usually expect an annual term.
Okay.
The people usually talk in years rather than half years.
And therefore, then when we do modified duration, then we should base it on
Years.
annual.
Yeah.
Okay.
Okay, so notice that though it's a number like 10, the way that we're actually going to use this, remember the formula says it's a percentage change in the bond price divided by some change in the interest rate. The way we're going to use it is to predict what's going to happen to the bond price. And though it's 10, people often put a negative in front of it to emphasize that if the interest rate goes up, the bond price goes down. There were a couple of questions. Yes?
I'm wondering if you can use duration or something similar in measuring project cash flows.
Absolutely. Sure.
Is that something that corporations use?
Sometimes, yeah. So the weighted average maturity of the project. And because it's unusual for actually a corporation to undertake a project that's got like a bullet cash flow at the very end.
Right.
So it works the very same way. Okay, so what I want to do is, remember we took the change in the interest rate and divided by 1 plus I, and I said that was not very intuitive. I want to get rid of that. Okay, so I'm going to take Macaulay's 1938 concept and modify it. And this is supposed to be an I. I changed this too. I can't believe it. What I want to do, take the duration, divide by 1 plus I, and that's going to effectively get rid of that last thing in the Macaulay formula. What it does is it tells me now the modified duration equals the percentage change in the bond price divided by the change in the interest rate. That's exactly what we want. That's the measure that we want. So it's the percentage change in the bond price divided by the change in the interest rate. Yeah, so if it goes 8 to 9, that's 1. Yes.
For this exercise, one for one, for the negative modified duration, because no book doesn't have a negative. It just is
What book is that?
the
Reading Wires?
Yeah, it's volatility, it's just duration over one.
I personally don't care that you can put it as a negative number or positive number. What I care about is that you use it correctly. So if you put it as a positive number and the interest rates go up, I want you to make sure that the bond price goes down. Okay, that's what I care about, that you use it correctly. Okay? Yes?
Well, you said we could do the duration on Excel.
Say it again?
You said we could do the duration on Excel.
Yes.
You can show us how to do it again, right?
Yes, basically I have. So you take basically a column of the cash flow. There's more examples here. Let me get to the examples. You'll see it's really easy to set up. Yes?
You said that R is supposed to be I,
Yeah.
and I represents the change in interest rates or just the interest rate?
Yeah.
I'm sorry.
And for this example, let's just say it's an annual interest rate.
Okay, and that's the coupon or the market?
Never, the coupon is never the market interest rate unless the bond is at par.
Market, okay.
Okay. There's also this concept called elasticity, which kind of looks the same. So it's a percentage change in the bond price divided by the change in the interest rate. That looks real similar to what we're working with. But what we're working with, the formula for modified duration, is the derivative of the bond price divided by the bond price divided by the derivative of the interest rate. So it turns out, when is it the case that this percentage change equals the modified duration?
When the changes in the interest rate are small.
Exactly, it's like the definition of a derivative, right? Remember in your very first calculus course, whenever it's you take the limit as the change gets real small, and then you approach the derivative. Okay, so what you're getting is the modified duration is like the slope at a particular point. Okay, for a very small change, it's incredibly accurate. whereas the elasticity is just a percentage change divided by a change. And note that this elasticity is a little different than what you're used to in microeconomics, because in microeconomics, I believe you got a percentage change divided by a percentage change. This is a percentage change in the bond price divided by just the change in the interest rate. Yes?
When I first started doing this, what confused me was like for the duration, I would do like 1 plus 0.05 or whatever the interest rate is. But when you do the change in I, if it goes from like 8 to 9%, technically that's a 0.01 change, but it really messes you up if you put 0.01 in as a change in I. How come?
Okay, so the interest rate, often what we do is, you could do the 0.01, but often we just put it in percentage terms, so it would just be 1. So 8 to 9 is just a 1.
So it's still like, so that change in I is really the change in 9%.
Yeah. You can also do it like you did it, but you just have to make sure that you adjust the scale. Okay. Now can I show you the way to do this in the spreadsheet? So this is a 10-year bond with a 12% coupon. This is a 5-year bond with a 12% coupon. We need the discount rates, or the price of zero coupon bonds. We've got the years in one column. We've got the price of zero coupon bonds in another column. Cash flows in the third column. In the fourth column, we take the present value of every single cash flow. And then we add that up to get the price of the bond. In the fifth column, take the present value of each cash flow and divide it by the price. Okay. And that's this thing here. Add that up, make sure it sums to 1. It should by construction. It's just a check of your program. And the column that's missing here is going to be column number 5 multiplied by the year. So it'd be 1 times 0.11, 2 times 0.1, 3 times 0.09. That's going to be a column. Add them all up, and you're going to get a duration of 6.22. Given we're in an annual world here, we're going to divide by 1 plus the interest rate, which is 13. Remember, 13 is not 12. The coupon is 12. The interest rate is 13. And we get a modified duration of 5.5. In this example, I also calculated an elasticity if we went from 12 to 13% fair interest rate. And that's real close to the modified duration. It's 5.47%. Modified duration is 5.5. Okay. The interpretation of this, it says that if interest rates go up by 1%, we predict that the price of this bond will go down by 5.5%. It's a prediction, it's an approximation, but this is how it works. Over here is a 5-year bond. It's got shorter maturity, so the odds are that its duration is going to be less. Okay? It's also got a 12% coupon. We do the same sort of steps. We've got the present value of each cash flow. We take the present value divided by the total price. And the column that's missing is the present value divided by the total multiplied by the years. Add it all up, and we get 4.02 years. The modified duration is 3.56. The elasticity is 3.48. So this again is telling us that if interest rates go up by 1%, this bond price is predicted to drop by 3.5%. Which bond has more risk? 10-year. Rates go up, then the price can drop by 5.5, whereas this one is 3.5.
Yeah. Does the elasticity formula work if interest rates go down by 1% too? interest rates go down.
Well, I think
price
in
go
the,
up.
in the assignment, actually, one question is, what I suggest doing, to approximate the modified duration, take the elasticity for an interest rate move up and the elasticity for an interest rate move down and average the two. And you kind of get close to the slope at that point, which is the modified duration. Modified duration is just the slope. So is that okay for a spreadsheet? You can see that's real, I think, straightforward to put in.
I thought that would be like sort of a building formula equation.
Well, in a way, it's just what you do in terms of getting the final number in the spreadsheet is the formula, right? There might even be a duration function now in Excel.
There is.
Yeah, I want you to maybe experiment with that, but I want you to actually code it in yourself through the column operation. Like, I want you to really understand what's going on behind the formula. Okay, so you can, I guess, check your answers pretty accurately, right? If you've got a function.
So based on what you just said, you can use modified duration to estimate movements in either way, right?
Absolutely.
Okay.
Yeah, because it's just a slope at a point.
Okay.
And this graph actually tells us what's going on. This is the bond price against the interest rate, and the red is the bond price curve. So this is just some generic bond, and all of the bonds are going to look like this. And all I'm doing with the modified duration is suppose that the interest rate is about here today. I'm figuring out what the slope is at that point. So I'm using the modified duration to answer the question, well, if interest rates go up or if interest rates go down, what is the approximate percentage change in the bond price? Now from this graph, you can really see that this is an approximation. This approximation is going to be very high quality if we're not moving that much in terms of the interest rate. But if the interest rate really jumps, you're going to be off. And the reason is that the modified duration is measuring a slope to a function that's curved. And this type of function is basically a convex function. So there's going to be an error here that's due to convexity of the function. So if rates really jump, you've got an approximation from your modified duration that is not going to be that accurate. And the other thing is that depending upon the maturity of the bond, the convexity could be much different. So the bonds that have very high maturity could be very convex. Okay? And this is just an example here of a coupon rate of 10% for a 5-year bond and a 10% coupon for a 10-year bond. I calculated modified duration and assuming that the interest rate was 10%, and looked at a predicted move if rates went up by 5%. So it says the predicted move here is -18 and -30. And then I calculate the actual move in the bond price. Okay, so that's a different exercise. Actual move in the bond price. And for the 5-year bond, it was -16.76. And the error of the duration approximation was 2.19. Whereas the other bond had a higher error. It's got more convexity. So this is, some people sometimes ask, well, why do you need the modified duration when you could actually just calculate what happened? And the answer to that is that you don't know what's going to happen. You're sitting today, and you're doing some scenario analysis or whatever. And you need to know, and you might have like 100 different bonds in your portfolio. You need some summary measure of how sensitive each one of those bonds is to a change in the interest rate. What is the most sensitive bond to a change in the interest rate? Zero. And if our zeros go from 1 year to 30 years, what is the most sensitive zero to a change in the interest rate? 30. Remember I said in one of the earlier lectures that the 30-year zero it's got a lot of sensitivity. Just calculating in our head, the duration, what's the duration of the 30? 30. The modified duration divided by the interest rate, 28. So it says that if rates go up by 1%, this bond will drop by 28%. That's a lot of sensitivity. Okay, so of all these bonds, that one is the most sensitive. There's some supplementary material here. You can actually measure the sensitivity in a more accurate way by accounting for the convexity. You're not required to do that, but the formula is there for you. And the very last thing before we take a break, we're running a little late for the break today, has to do with the hedging interpretation. And again, this is something that we're not quite there on because we need to do the options and futures. But if we're in a scenario where we've got, you know, let me do kind of a different example than is here. Suppose we're sitting on the 30-year zero coupon bond. It's in our portfolio. Okay, and we've invested, you know, like $50 million in that bond. And we believe in the shorter term that interest rates are going to go up. Okay, it might go up 1% or even 2%. So we stand to lose 50% of our investment. And it turns out one alternative, what's the immediate alternative? Dump the bond. But to do that, there could be transactions costs, and maybe it's a good investment for the long term, but in the shorter term, you want to hedge. So basically, this is the idea, that hedging will provide a positive cash flow when you experience this bad scenario, the interest rates going up by 1 or 2%. The key is to do the right amount of hedging. Well, the first key is to get the direction of the cash flow correct. So when if the interest rates are going up, you better have a hedge that's paying you off. Okay? That's the first thing, but I kind of assume that everybody's going to get that way. Second thing is to get the amount right that's being paid to you. So if interest rates go up by 1%, on this 30-year zero that I'm holding, I stand to lose, I said it was $50 million, I stand to lose 28% of 50, $7 million, is that correct? Something like that? Stand to lose $7 million. So what I'm going to have to do is to enter into a hedging transaction. We might use options, which we'll talk about in the second half. We might use futures. The hedging transaction needs to pay me off $7 million if interest rates go up by 1%. Now it turns out that the bonds that trade in the futures or the options are not identical to the bonds that we actually hold in our portfolio. There's actually no 30-year zero coupon bond that we can use directly for hedging. And actually the most logical bond to use is a bond that's got 15 to 20 years to maturity that's got an 8% coupon. And what's the modified duration of that? Well, it's 7. Okay. So I've got to be real careful to take the differences in the sensitivities into account when I construct my hedge portfolio. That the bond that I'm using to hedging is different than the bond that I've got in my portfolio. The sensitivity is much different. So in order to construct a portfolio that gives me a payoff of $7 million, then I'm going to have to undertake a transaction recognizing the modified duration of the hedging bond to match the cash flow. And what this note just goes through, and we'll talk much more about this, is that the key to setting up this hedge is the recognition that the duration or the sensitivities are different. The other thing is sometimes I'll just say duration. Like from now on, duration means modified duration. Okay? duration, Macaulay duration is only a way to get to modified duration. Okay, well that's basically what I wanted to talk about in terms of bond valuation. Let's take a break, and we're going to return to this hedging example when we do options and futures. Okay.
And we lost it.
Okay, next I want to talk about options, which are derivative instruments. And I forget exactly where we are in the schedule. Were we supposed to complete options today? Yeah. Well, so we'll get an introduction to them. As I said, I'm pretty flexible on this stuff, and if we don't get through futures for the midterm, we'll just make an adjustment. Okay, so don't. I said this last time. I'm not interested in pushing so hard as to lose people. That this material for a lot of you is new. It's going to take a while, and it's actually expected that at the beginning, because we're so compressed into 6 weeks, that there's going to be some struggling. Okay, but my goal is by the end of the course that you're going to know way more than you came in. Like the actual what we deliver in this course is, I think, a lot in terms of value. Okay, so if you're struggling a little bit right now, because this assignment is a long assignment and a hard assignment, just bear with it. But after this assignment, I tell you that you're going to be an expert in bond valuation. Like you never imagined that it takes you through a lot. It's long, but the present value, the net present value, not the present, the net present value is really awesome.
Yeah, just briefly. Are we going to, at the end of the course, are we going to chop off material, or we're just going to make it out later?
We might have to chop some stuff that, like it's a sprawling site, right? If you've gone through it, right? There's stuff all over the place, and we'll do more, right? It might be that I can't cover everything. Like, I would have loved to have spent a couple hours on term structure of interest rates, right, and recite my dissertation or something. But maybe it's something supplementary. If you're interested, then you go back and visit. Right? I'm not going to pull an exam question off the stuff that we don't visit. Okay, so it's more a lot of stuff that's available. We won't be able to do all of it. So don't. So I always get this question: is this on the exam? Whatever. Okay, any other questions? Okay. Well, I want to talk about options. And options have got actually a lot of bad press. Who said this Business Week article where they published the Bankers Trust tapes? It's great. So the bank. Who works for Bankers Trust? Anybody? Do you work for Bankers Trust?
No, I wanted to say one of their clients was Air Products and Chemicals. They like about $107 million, which is a percentage of revenue of a lot. And the treasurer and the CFO were fired. Well, they weren't really fired. They were, I guess, asked to leave with a nice package, but they left anyway. So it was a big deal.
Absolutely. And the reputation loss for Bankers Trust is now their name is almost like an oxymoron. This is a huge, but it's really indicative of kind of what happens out there and the dangers. It's like everybody's got to know this stuff. You got to know it because it really impacts all facets of business now. And even though there's bad press for options and derivatives, they're definitely here to stay. And what I'm going to try to do is to go through some basic stuff. Right? It's basic, but it's not that basic if you've looked ahead in the lecture. So a call option is a right, and sometimes options are called rights. It's a right to buy, and that's an support. So call is a right to buy, whereas a put is a right to sell. It's a right to buy a fixed amount of something at a fixed price on or before a particular date. The fixed amount, if it's an equity option, is 100 shares, usually. They're quoted on the basis of 1 share, but a contract is usually 100 shares. So I'll put up an overhead of listed option quotations. You can see how to read them. But they're quoted on the basis of 1 share, just like the bond is quoted on the basis of $100, but nobody buys a $100 bond. So this contract is for 100 shares. The exercise price or the strike price is the price that you agree to buy, or you've got, let me rephrase that, you've got the right to buy it. And the key thing with an option is that it's a right, but it's not an obligation. So if things happen that are unfavorable to the actual contract, you can always walk away from the contract. So you've got the right to purchase at a certain price on or before some future date, but you do not have the obligation. So if IBM's trading at 98 today, and you buy options to purchase at, let's say, 100, 3 months from now, and the price of IBM over the next 3 months drops to $70, are you going to exercise that right? It'd be crazy. Because you'd be paying 100 to buy something that's worth 70. If the price goes to 150 over the next 3 months, are you going to exercise the right to purchase that 100? That's a great deal. Because you can buy that 100, what did I say, 100 or 105 or 110 even, and then sell it immediately for 150. So it's basically how these work. And the example that I've got is an option on a bond. Okay, so we're going to start out and suppose that the price of the bond is, it's a treasury bond, and this is a time where interest rates are quite high. And suppose that buy the option, and you've got the option to buy at 76. And if the final bond price, this is going to be called a payoff table. If the final, you've got an option to buy at 76. If the final bond price at the end of the period of the option is 76, then there's no money to be made. Okay, because you get the right to buy at 76, but the price of the bond is 76. The option really isn't worth anything, and actually you've taken a loss because the cost of the option is $1.50. If the final price is 77, well, you've got the right to buy at 76. You can sell it immediately for 77, so you make a $1 profit, but you're still in a loss situation because the price of the option was $1.50, so you lose now only 50 cents. And you start to break even, or you break out into the profit, the net profit situation, when the price of the bond rises above $77.50. So if the price actually rises to $90, okay, what interest rate environment would cause that? Interest rates went, somebody said that. Yeah, so interest rates are going down, price is going up. So we've got the right to purchase the bond at 76. We can immediately sell it for 90, which is a $14 profit. And our net profit is 12.5. This is just a payoff table. Notice this 12.5. What's our initial investment? 150. What's the rate of return on this purchase? Big. Real big. So if I bought the bond at 76, an alternative is to buy the bond at 76 and hold it. and interest rates went down, the price went to 90, profit's 14. And what's the return on that? It's 14 divided by 76, my initial investment. Whatever that is, 20%? 18. 18, okay. The option's got a way higher return. So what you get is leverage in a big way. Now often with leverage, you've got the downside, right? Do we have the downside with the option? Just what you pay. So notice there's kind of a nice instrument, and you got this spectacular upside, but no downside other than what you initially pay. So it's got limited liability. So it makes it kind of popular. Now this is a graph of the call option payoff, which didn't quite come through. So what I'll do is reload that. And while we reload, let's look at the put option. The put option gives us the right to sell at a pre-specified price. Okay? It's a right, not an obligation. Let's use the IBM example again. So IBM's trading at 98. I purchase a put option, and it gives me the right to sell 100 shares of IBM at 100. Okay? Now let's go through what actually happens. Suppose that the price goes to 120. Am I going to exercise this put option to sell at 100? Well, suppose I was foolish, and how would this work? Well, I've got the right to sell at 100. I don't have the shares, so I'd have to go into the market and buy the shares at 120, and exercise the option by selling them at 100. Not too smart. Okay, so that'd be irrational, and I definitely don't want to do that. Okay. Suppose the price goes to 80. Am I going to exercise? Yes. Okay, so I could go into the open market and I could buy the shares at 80. And then I've got the right to sell at 100. So make a $20 profit immediately. Okay? Yes?
Who would want to buy it at 100 when the market price is 80?
Who would want to buy? Well, anybody answer that question? Yeah, somebody's got to sell me the option. So maybe you sold me the put option. I pay you for it, right? So I pay you whatever the price of the put option was. Again, we lost our graph, but I think I said it was $2. $2. I pay you $2. Okay. And if the price goes up, you've got $2 in your pocket. And if the price goes down, you're facing a situation where, with the IBM example, you are obligated. This is not a right. You can't walk away from this contract. I've got the right. You're obligated to pay me $100 if I sell to you. So you're going to take, what's your loss? You're going to pay 100 and sell it in the market for 80. You take $20 loss, but I had paid you originally $2 for the option. So the net loss is 18. Okay, we can kind of see this on the payoff here. This is the option to sell at 76. Notice as the price goes up, we never exercise the put option. As the price goes down, then we definitely exercise. And at the $60 price, we've got the right to sell at 76. So our gross payoff is 16, and our net is 14. Yes,
The second line there.
this is incorrect number. Everybody see that? What should this number be? 4. Here? 4. So mark that, I'll change that when I get back to my office.
Who is typically on the other half of is it brokerage?
Could be anybody. Could be anybody. And it's almost never brokerage house because they'll find somebody else to do it. Who was on the other side in Bankers Trust thing with P&G? Well, if you go through that example, and I'm sure they do it in the second year derivatives course, it's actually P&G, in setting up their hedging program, actually wrote the option. They sold the option to Bankers Trust, and the Bankers Trust, I guess, was laughing all the way through that. So because they sold an option to Bankers Trust basically free. So you never know. Somebody's on the other side. Notice the liability is much different if you're selling. If you're selling an option, you can get into big trouble. If you're buying an option, you can only lose your initial investment. In this case, $2. The liability is limited when you buy. So a simple rule for not getting into trouble in derivatives is don't write options. Don't sell options. And it's unusual to have a hedging program that is selling options. Yes?
Don't most dealers or creators of options just sell a call and put it at the same time, which essentially engage each other and they just take a spread?
They could do that, but for sure they're hedged. So it might even be more complicated than what you're suggesting. But they set up a program to make sure that they're not exposed. They're going to make the spread. They're going to charge you a little extra than what it's actually worth. But they cannot take the risk. Yes?
If I buy an option on the open market, how do I know who I'm buying from? Because it seems like there's some counterparty risk, but if that other party is unable to fulfill their party's obligation,
Right.
then it's...
So there's two ways to buy the option. You can buy it on the exchange, and then it's guaranteed by the clearing house of the exchange. So everybody puts some capital in, and everything's guaranteed. You don't know who the counterparty is. All you know is guaranteed by the exchange. The other way to do the option is an over-the-counter option. And that's where, you phone up somebody and there could be some counterparty risk. So the person, that I sell you the option, the price explodes and you're going to make a huge profit. I'm going to take a massive loss. I declare bankruptcy. And you don't get the upside. So there's counterparty loss. There's ways to minimize that by insurance and margin and stuff like that. Mainly what we'll talk about is exchange traded options. The rest not an issue. Okay. So it's just the payoff at the put option. You can see. And we do have a graph. Well, you've got the graph anyways, the hard copy. So notice that the put option is a bet on the price to go down. It's a bet with limited liability, and that the maximum loss you can take is $2. And you benefit from the price going down. So the more it goes down, the more money you make. So I just plotted the gross and the net payoffs here. This payoff diagram we're going to see many, many times in this course. You should be familiar with this. The payoff at expiration, and notice this is the final asset price. It's the price when the option matures. Okay. Now what about selling the option? We already talked about it. The selling, yes?
Why would an investor, except in cases where he or she wants to hedge against an investment, want to write an option? Because there's only a limited amount of money per minute and the liability.
Write a lot of them.
Why would they want to except in positions of hedge?
Well, what you're saying is the red line is not that attractive of a payoff.
No, writing an option.
Writing an option, well, if we reflect it, let's say. So it would be positive $2 all the way along here, and then you start to lose.
Right.
You're saying that's not that attractive.
Yeah, you have a limited amount that you can make, and you lose a whole lot.
Yeah, but it turns out that the probability is 90% that you're going to make that limited amount, and 10% you're going to take the big loss. When you calculate the expected value, it's okay. But you have to recognize that there is this chance of the big down. It's just a different investment. And suppose nobody will sell at $2. What's going to happen? Nobody's going to sell this option at $2. It's going to go up, and then somebody's going to come in and say, well, that fixed payoff for 90% of the times is enough for me to take the downside loss. Okay, well, this is just a position where you're selling a call option, and it's real easy. You take the net payoffs that we had from buying the call option, put a negative sign on it. That's all I did, just put a negative sign. Okay? Notice that as the price goes up, you bear with really unlimited liability. That the price goes, well, this is a bond, so it's not going to go too high, but if it's a stock, who knows where it goes? Go to 500. So this is like infinite liability when you're selling a call option. Okay? And this is the payoff. And you can see that it just keeps on going down as the price goes up. Notice that this diagram looks very similar to the positive call option. It's just reflected in the y-axis. So there's 4 diagrams that you should be familiar with. The buying the call, the selling the call, or writing the call, the buying the put, and the selling of the put right here. Notice that technically the liability on selling a put is limited, because the price can never go below 0. So it's not going to explode to infinite loss. But that's still pretty substantial loss to pay. You invest $2 and potential negative is negative 98. So there's a written put. So you should know how to do all of these diagrams, and there's examples where you actually work through. This list here is a list of where options are traded. These are all available to you, and I actually encourage you to look through the World Wide Web thing that I put up, Guide to Futures and Options Quotations. And all I did is kind of copy all the links into this lecture note. There's stock options trading on these exchanges, for example. We've got index options on things like the S&P 500. Those are available. We've got long-term options. Somebody asked, do I have to buy options on this exchange? No. For the assignment, you can buy options anywhere. I don't really care where they're coming from. We've got options on futures contracts. Now, given that we haven't done futures yet, that's a little confusing. So you might want to avoid those, but if you want to invest in them, that's okay. You could look ahead. And there's all sorts of options on futures. Currency, catastrophe insurance, that's a new one. So let's, this is a page from the Wall Street Journal. I would link to it. I can link to it, but it'd be faster because we're running a little short on time. I just wanted to show you what an option quotation looks like, because this is actually what you're going to be doing for this assignment. Okay? You need to open the paper. You need to decide what you want to invest in. There's no correct investment, so don't come to me and say, well, what should I invest in? I don't care if it's a random selection. Okay? The point is, let's just follow to see what happens. The simplest possible thing that you can do in assignment number 2. And if you're a little unsure about your portfolio to start with, you could invest, like 50, what is it, it's $1 million. So $500,000 in IBM stock and $500,000 in IBM call options. And if you want to get a little more risky or diversify a little more, then you can trade into a different portfolio later. So what I just described to you was kind of the 5-minute version of assignment 2. Okay. 15/50. Basically one stock IBM and one call option on IBM. But generally, you're gonna be doing, I know this is difficult to read, it's kind of unfortunate, but this is an example, let's say AT&T. The first column, basically, you can't read it, I'll just tell you what it is. The first column lists the final stock price for the day, and the second column lists the different exercise prices. The third column lists the expiration date for each option. And don't buy the nearest options. Go out, like a couple of months, so that we don't have to worry about options expiring. And then the calls are listed, and then the puts are listed. So, for example, the call that says that you can purchase AT&T at $50, even though the price today is 52 7/8. And the third week in January is trading for $4.50. Okay, so to do one contract, you multiply $4.50 by 100. So the cost of buying these call options, which gives you the right to purchase at 50, in the third week in January, is $450. You've got the right to purchase 100 shares at $50 a share, even though the price today is 52 and, I can't even read it myself, 52 7/8. So almost immediately the option is, in the lingo of options, in the money. You've got the right to buy at 50, it's already above 50. And you're going to pay $4.50 for each share. And we can also look at the put options. They're listed to the right. And the put options, they say for the same strike price, the same expiration, where it gives you the right to sell 100 shares of AT&T at $50. In the third week in January, the price is $1.25 per option, so you multiply that by 100. So what I want you to do, and this is important, you have to realize that when you buy call options, you're betting on the price to go up. So if you think the price is going to go up, then you're going to be taking call options. If you think the price is going to go down, then you should be taking put options.
Can you not buy or sell into the contract?
You can do it beforehand. Okay, so it turns out that you can always sell the option in the open market at any time. So if you want to hold it for one day, that's fine. We're assuming no transactions cost in society. Usually there is. Yes. You bet, you bet. But for this assignment, we're going to ignore that. Okay, the other thing, the last thing is that, and just let me ask this one last question. If you believe the price is going to move big, but you don't know which way it's going to go, up or down, what are you going to do? Buy both. So you buy a call, and it seems like a contradiction, where you buy a call, which is a bet on the price to go up. You buy a put, which is a bet on the price to go down. And you buy both. And if it goes up really big in the positive direction, then the call is going to have a huge payoff. And you walk away from the put. It costs you like $2. And if it goes down in a big way, then you're going to be very profitable on the put. And you walk away from the call. So people do this all the time. They think that the stock is going to move, and there's information coming out. You don't know if it's good or bad news. We know the stock price is going to move, but we just don't know what way. So you actually buy both a call and a put. So there's many different combinations that you could do. You're welcome to experiment, but let's get an initial portfolio in. Then after maybe Monday's lecture, we can trade, okay, into something more general. Yes?
What's the actual expiration? Like, you know.
Okay, also, any questions on the specification are in the Guide to Futures and Options. The actual expiration is the Friday before the third Saturday in the month. okay? But you don't need to worry about that, because take the options that are like at least 1 month out.
If you're trying to value it, you would want it. You have to get
Yeah, you need to
insurance,
know
right?
what you're valuing. We're not valuing yet, okay?